Big blunts, dope boys wanna smoke with me. Now we ride double M's through the whole city. Niggas talking down, but they always feel me. A 9-figure nigga, all I wanna talk is business. I seen a big mouth get a closed casket. Self-made, took over the whole racket. A kilo after kilo, see who moved the most. 200-foot yacht, she wanna see the coast.
What's going on, YouTube? Welcome back to Goofy Investing, where we talk about investing in the stock market. Welcome back to the underground. We're going to do a stock analysis on a dating website or a dating app called Grnd. All right, ticker GRND. Trades on the New York Stock Exchange for $11.96 a share. Market cap's $2.24 billion. We're going to look at some financial fundamentals, some of the business model. What do I assess about this sector and so forth? This is a dating app that specializes and focuses on gay men, gay and bisexual men. And pretty much they are headquartered in Hollywood, California. All right. So before we continue, thoughts and philosophy on moralities of investing. Me personally, I'm an equal opportunity investor. I don't put stock into morality as far as selling drugs, weapons, sin stocks. Me personally, I will own companies that sell weapons, drugs, whatever. And also on the other side, I'll own companies that sell morale type business models, such as how do you say, the angel company or what have you, the honest company, eco-friendly companies. It doesn't matter wherever the money is, I'm gonna be okay. So whenever I do the analysis on all of these companies, you can take it that it's non-biased. All right. If it's a good investment, it's a good investment. If it's a bad investment, it's a bad investment. I'm just going to keep it real. We're going to look into that today with Grnd. We're going to see what do I assess the investment proposition to be. Is this a stock you maybe buy a small position in, big position in? Not financial advice as usual, but we're gonna look into it. Disclosure: I don't own stock into Grnd. Yeah, I do not hold a position, and this is the first time that I'm really looking at the actual company, to tell you the truth. I didn't really know that it was even in existence. I am a heterosexual male that's been married for over a decade. So take it for what it's worth. I do know that based on feedback from coworkers and just people in general, that the dating market is in a state of decay. They say it's trash or so forth. I mean, maybe maybe these dating apps are the reason for it. Maybe it's social media. I don't know. All right. But all in all, it is what it is. And it's a problem it's a problem within society. And if a company can solve that problem, I believe those shareholders of that company are going to get rich. So I'm always going to be on the lookout for that type of stuff. All right. So let's look at the balance sheet real quick. Let's do a sniff check here, see how much cash they got. Okay. So they have net debt. All right. They have more debt on the balance sheet than they do cash. Cash is looking like 120.83 million. Debt looks like 287.64 million. So over two times leverage there. But all in all, once I see a 2 times leverage company, the first thing I'm gonna look at is their margins on their free cash flows to see if they have any. All right. And what do you know? Excuse me. What do you know? They have a high free cash flow margin. All right. And they have a high gross profit margin. And they have a high EBIT margin, high EBITDA margin on their 5-year average. Gross profit is up roughly 23 basis points, 27 basis points, whatever. EBIT margin is up over 4.5%, and EBITDA margin is down slightly by a few percent. Net income net income margin is increased on the downside, about maybe little under 1%. All right. But free cash flow margin has gone up about 4%. So whenever I see high margins and then low net income margin, I'm automatically going to look for stock-based comp in their operating margin as well. So let's look at that. All right. Revenues 385.1. When we go back to it, we said that this company is trading at 2.24 billion. All right. So pretty high price to sales there. That's We're looking at over 5 times right on the top of my head, and we'll look at it on the valuation metric. But SG&A is high. All right. SG&A takes up a big portion of the revenues. Of course, it's not annotated as a cost to revenues, but the way I see it, I kind of lump operating expenses into the cost of revenues with these type of tech SaaS companies, because all in all, with these tech SaaS subscription model companies, you're really betting on people. There's a big percentage of your bet as an investor on a company's success based on the execution of people. All right. So R&D seems to be going up, but not as dramatically, not as kind of see some volatility on the year over year with their R&D. I've reviewed their pitch deck, and pretty much they're building a full stack AI platform. All right. So that costs money. We'll just get that out of the way. It's going to cost money if they're building a full stack um, platform. As far as their app goes, I would expect R&D to continue to go up. Depreciation and amortization, maybe that's the building they own, because this is more of a light company as far as property, plant, and equipment. I mean, it's an app, right? So operating expenses, other operating expenses, all right? So that can that can be one-offs, that can be all different types of stuff. Let's go to their cash flow statement and look at stock-based comp. Yep, stock-based comp is going up. There was a decline in stock-based comp in 2023, but then quickly over doubled, and then year over year, even on the trailing, we're going up. So looking like 50 million in stock-based comp. All right. That's not necessarily good. That's not necessarily bad. Based on that and what I've seen, what I'm going to look at is insider ownership next. All right. So I'm going to go to stock comparison and do a multiples comparison against match, and we'll do analysis there. All right. So we're going to go all the way down here to look at ownership and see how much own. Okay, there it is. 68.13% insider ownership. The insiders of this company own most of the company, and it's trading on the New York Stock Exchange. I like to see high insider ownership, but I don't like to see like 70%, 68%. If they're right there on that 50%, honestly, 50% is really high, and that's good, because 50% is really that fine median to where the ownership can sell a good chunk of stock, and the company and the shareholders can benefit off indice inclusion, S&P inclusion, and prestige of ownership. All right. So if you get a company with high insider ownership, yes, there's pros to that, because the insiders care about the stock. So they're not going to let the stock languish too much. And at the same time, on the flip side, a con to that is you're going to see way more insider selling when the stock goes up, because they know they're going to need to relinquish ownership, but at the same time, they don't want to sell the stock for cheap. All right. They don't want to sell a piece of their ownership for cheap against the market. All right. So what does that do? that puts a lot of resistance on the stock when it starts running, and it kind of caps it out. And then after interest fades, the stock bleeds right back down. All right. Institutional ownership is looking like below 20%. Match is a complete opposite. They have 0.58%. Not even 1% of the company insiders in Match own it, and 93% of institution is all institutional ownership. All right. So there's that to consider. If you're betting on the people better have a decent stake in the company. But at the same time, if they own too much of the company and they're garnering stock based comp, when I'm judging a business, all right, when I'm judging a business, is that you got 4 PE metrics. You got your trailing non-GAAP PE, you got your forward non-GAAP PE, and your non-GAAP PE are exclusions of stock-based comp. All right, while your gap and your forward gap are inclusions of stock-based comp. This is as pure as it's going to get. Generally accepted accounting principles. All right. When you look at earnings consensus estimates, when we're looking at it right here, it looks like on a forward non-GAAP basis, we're trading below the peg. All right, or close to the peg of 1. And then the next year is really the one I'm going to look at. Non-GAAP forward PE 20.74, when I'm looking at the growth rate next year of 22.69. So we're trading below the peg on their growth. So the growth is not priced in. Why is the growth not priced in? Well, the street is not going to give the company credit at this point in time with such a high insider ownership when they're getting a bunch of stock-based comp. So even though they're a young company to the market, which let's go back to the chart, looks like they did a SPAC here. This looks like a SPAC chart. And then, yeah, this makes sense. So they've been around maybe just a few years, shy of a few years. All right. 2 years, 11 months, whatever. Um, the market at this point in time with such a new company should be judging the stock on a forward non-GAAP basis for valuations. But due to their high insider ownership and stock-based comp and some of the macro sentiment, they're not going to get much credit for their growth. All right. So the growth is not priced in. However, the company is garnering a premium due to these sales, the price to sales right here. All right. So what I'm going to do, and I got bad news for Grindr investors later on down the road. All right. So the bad news is this. All right. The company is pricing in future performance all the way up to the point to where they're going to match the sales valuation on a price to sales metric against Match. Yes, pun intended. I'm going to match the sales multiple against Match's sales multiple. All right. So Match is trading at a little over 2 times. All right. Once Grindr hits a certain threshold, there will be a correction in Grindr's sales multiple to match that of Matches. All right. So once Grindr gets to enough scale in sales and this growth starts dropping off, I would expect Grindr's price to sales to be around a little over 2.5, three times sales. Okay. So we'll pull up the handy dandy calculator. Let's say that in 5 years, Grindr does 1.05 billion in sales. Okay. And let's say these consensus estimates are right. All right. Which they're probably not, but let's just say they are. All right. So we'll go to one. So we'll go to Match. 2 point, we'll go 2.17. All right. So, oops, excuse me. 1.05 in sales at the tune of billions or billion to be more accurate, times 2.17. So that puts the valuation in 5 years at 2.27. Oh, would you look at that? All right. The market has priced in the next 5 years to matches price to sales valuation. That is what I assess is going on right now with Grinder. All right. So what does that mean? Well, the stock can, let's look at the chart. I think there's a good chance the stock reverts back to around $8. All right around here. I think they revert back maybe, yeah. We're looking at maybe a reversion back to the eights. All right. And then what you'll see is a slow, steady incline on the stair step. So this is going to go back down. I think it's going to go back down. It's going to correct and go back to the eights. And then from the eights, you'll see a reversion to where some time will lapse. They'll grow sales, and then they'll stair step back to and match. I'm going to close that out and match this 2.27 billion market cap. All right. It looks cheap right now to the, how do you say, a more an investor with some moderate skills, so, but I think that's pretty much what's going on with Grinder. All right, let's get into some business fundamental analysis, because this video is kind of going a little while. So the pitch is 52% of gay men in the U.S. have a bachelor's degree versus 36% of all adults, and 50% of gay men have an advanced degree than straight men. Advanced degree, okay? How do you define that? We're talking MBAs, doctorates, Juris Doctorates. These are doctors, lawyers, higher caliber businessmen, etc. All right. Gay medium household income households are looking at 128K on average. So, and I've done a little bit more research. There isn't much statistics and analysis on this stuff, but it seems to check out. Okay, gay men make more money on an average, and they're more educated compared statistically against society. All right. So the business model of Grinder is more selling to a kind of a wealthier cohort of customer base, a niche. Nonetheless, they're niche because everybody has a preference. First of all, where you have the actual categories of straight and gay. All right, you have people like what they like, okay? But within that, not everybody likes the same thing. So you have eliminated a good portion of subset of TAM because not everybody is gay and not everybody is a man. And then of those gay men, you've also eliminated another subset of more income based and education based. So their TAM is more niche. Their customer base is more niche, but they make more money. So that's okay. All right. And when I look at a TAM that's more niche, you better have the gross margin to back. So they do have the gross margin over 70%. I'm okay with it. All right. Free cash flow, it's good. They got a buyback running. We'll look on a quarterly basis. We'll look at shares outstanding real quick. Last quarter, they had basic weighted average shares at 189.8 and diluted at 201.0. On the earnings call, I've listened to the earnings call. They've eliminated all the warrants out there. All right. So they have this big of a gap, you see, compared to this quarter. They have lowered a bunch of the gap of different, how do you say, dilutive equities and so forth. They've eliminated a lot of that. So that gap is closer, which I like to see. Business financial fundamentals are really good. Revenue's going up. All right. And share stock based comp is offset at this stage in the actual, at this phase with this company's going through, their buyback is offsetting the stock based comp. So they're pretty much starting to slow down dilution, is what's happening. All right. Balance sheet analysis, cash is going up. We'll go to their debt. Let me see here. Debt is going down. All right. So cash is going up, debt is going down. These are strong fundamentals. Cash flow generation is positive and growing, while net income loss is kind of just up and down, kind of flat. All right, flattish within the last few years. So all in all, they can easily make this gap profitable. When I look at the profitability metrics, this is the classic example of it's in the management's hands of they can force the street to boost the stock by generating pure gap net income by scratching stock based comp, and on a gap basis they'll eat, with the growth and everything, they'll eat away at that negative 14% like nothing. But it's a decision that the management needs to make. Me personally, I mean, they own 60 something percent of the stock. Why do they need more? I mean, that's just me. All right. In fact, I say they scratch their stock based comp. The stock boosts. They sell portions of their equity, and them selling portions of their equity while the gap net income just comes in, they will be able to sell their stock at higher prices. And when they sell their stock, smart money is going to notice that their threshold is going to go below 50% ownership, and the float will open up for institutional ownership. And when the institutions see that opening, the institutional money will start flooding in, and the possibilities of an indice inclusion, such as your S&P small cap, S&P 400 mid cap, etc., can kick in. All right, that's my stake on it. That's my take on it. I think it's me personally. It's not for me. I already have. There's other opportunities out there in the market that I'm looking at, and I'm already positioning in. Quick plug, check out my Patreon. All right, I got a lot of content on there. You get to know the latest and greatest in what's going on, my latest analysis and research that I'm doing. You get access to the deep dive collection, investor developmental series, more access to me. In this last deep dive, or one of the deep dives I did, I valued IP of tech. I got a slide deck here. I show you how to do it. I do it real time. I upload other products such as patents. All the research is documented and recorded, and etc. They're for investor development, not a lot of these content creators that are high growth investors actually do this. All right, I teach you how to do this. All right, very cheap, $10 a month. Start a free trial, check it out. If you don't like it, nix your trial or cancel it or whatever. It's all good. But for the money, you get community development, and so forth, more access to me, and you're helping the little guy out. But that's my take on it. I hope you guys enjoyed this stock analysis. You learned something or a thing or two. Comment down below on what you think. And with that being said, thank you all for your support, and take it easy.